Hello, I'm Jay Lerner, the Inspector General for the Federal Deposit Insurance Corporation, the FDIC. We're pleased to announce the recent issuance of our report on the FDIC's termination of Bank Secrecy Act anti-money laundering consent orders. Money laundering is a serious crime that aims to conceal or disguise the illicit proceeds of another unlawful activity, such as drug trafficking, terrorism, cybercrime, or other white-collar crimes. Essentially, money laundering tries to cover up criminal behavior by making illegal profits appear to look legitimate. It's been estimated that global money laundering could reach as much as $2 trillion annually. The Bank Secrecy Act, or BSA, has established record-keeping and reporting requirements for financial institutions to implement in order to detect and prevent money laundering. Bank regulators, like the FDIC, play a critical role in helping to ensure that banks maintain adequate Bank Secrecy Act and anti-money laundering, AML, compliance programs. FDIC's examinations of banks for compliance with these requirements are essential elements in identifying potential weaknesses in a bank's BSA AML program. When a financial institution is not in compliance with such requirements, the FDIC may issue a consent order, which is a formal enforcement action against a bank. A BSA AML consent order often contains several provisions or actions for improvements to the bank's program, and examiners review a bank's progress in addressing these consent order provisions. Our office conducted an evaluation to determine whether the FDIC had acted consistently with other federal bank regulators in terminating BSA AML consent orders, whether the FDIC had terminated such orders in accordance with its own guidance, and whether the agency had monitored its termination decisions in order to ensure consistency throughout the country. I'm joined here today by Terry Gibson, our Assistant Inspector General for Audits, Evaluations, and Cyber, who will discuss the findings and recommendations in our report.
Thank you, Jay. Our work determined that the factors considered by the FDIC to terminate consent orders differed from the factors used by the Federal Reserve Board and the Office of the Comptroller of the Currency. As a result, for one of our sampled consent orders, the FDIC and the Federal Reserve Board assessed similar facts about the bank and its holding company, but came to different conclusions regarding the timing for terminating their respective BSA AML consent orders. The Federal Reserve Board maintained its consent order longer than the FDIC, while the FDIC terminated its order and included uncorrected provisions in an informal enforcement action. The issuance and termination of consent orders are made public, but informal actions are not public documents. In terminating its consent order, the FDIC limited transparency and may have given the public, including bank customers and investors, the impression that the bank had complied with all previously issued BSA AML consent order provisions. For the 10 consent orders that we reviewed, we found that 6 consent order terminations appeared to be within FDIC guidance because the banks addressed provisions prior to terminating the order. However, for 4 consent order terminations, FDIC guidance did not address how to apply the terms substantial compliance and partially met as a basis for terminating a consent order. As a result, the FDIC could not be certain that these 4 consent orders were terminated using a consistent interpretation of these terms. The term partially met provides extremely wide latitude to terminate a consent order when any portion of it, large or small, significant or insignificant, is met. Clear guidance is important to ensure that FDIC regional offices consistently apply termination guidance. Without clear guidance, banks could be treated differently depending upon their geographic location. We also found that termination decisions were not centrally monitored. Monitoring decisions made across regional offices would serve as an important internal control to identify the potential for inconsistent application of FDIC guidance across regional offices. Further, the FDIC did not consistently prepare and maintain documentation in its system of record to support the monitoring and termination decisions for BSA/AML consent orders. The omitted documentation limited the support for the FDIC's BSA/AML consent order-related activities. In addition, because the FDIC did not correctly document consent order terminations in its enforcement action tracking system, the FDIC provided 9 incorrect reports to the FDIC Board of Directors concerning enforcement actions and did not report 3 BSA/AML consent order terminations in a quarterly report to the Financial Crimes Enforcement Network, or FinCEN, within the Department of the Treasury. Finally, the FDIC did not have adequate controls to identify terminated consent orders in its publications. We made 10 recommendations to enhance the FDIC's BSA/AML consent order termination guidance and procedures. Back to you, Jay.
Thank you, Terry. The findings in this report are important towards improving the FDIC's termination processes. The actions that we have recommended will strengthen the FDIC's practices for determining when to terminate such consent orders, promote transparency of the FDIC's decision-making procedures, enhance the FDIC's documentation and record-keeping systems, and improve the accuracy of BSA/AML reporting. To view this report and our other oversight work, please visit our website at fdicoig.gov. And you can follow us on Twitter at FDIC_OIG. Thank you for joining us today.